Hey there, everyone, and welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com, normally from Redmond, Washington, today from a beautifully sunny and hot Boston, Massachusetts. A real pleasure to visit some of my old colleagues at the Fidelity and have a great time exploring the city here in Boston, talking markets and talking charts. And we're going to recap a little bit what we saw in the markets today here on Thursday, July 18th. Let's get right to the market recap and focus on what I think, best describe as a distribution day. And I would say a couple things make me say that or provide that particular label. Number one, markets were down. And it wasn't just the mega cap growth stuff this time. The Nasdaq was down about 0.7%. The S&P 500 down 0.8%. You can see mid caps and small caps all down as well. So earlier in the week and really in parts of last week, you saw small caps and mid caps doing quite well. The Dow up while the Nasdaq was down. Today is more of a broad distribution. Very few sectors actually finishing in the green. A lot of names pushing lower and the VIX pushing higher. And the VIX now above 15, which is sort of that cutoff level, that line in the sand that we talk about, that a VIX below 15 is sort of a low volatility kind of, everything's fine sort of environment. VIX above 15 starts to feel like something a little bit different. So we will spend a little time talking about volatility. We'll talk about market trajectory given today's big down day and the down week that we've experienced so far. A little bit about market breadth, and we'll focus on which areas of the market are actually showing a little more strength than average and where there might be some opportunities. Getting to some other asset classes here, you can see the 10-year yield finishing the day around 4.19, the long bond yield around 4.4%. The short end of the curve is still elevated, of course. We're about less than 2 weeks now away from the July Fed meeting, which is when we may see a first rate cut to be determined. Curious what you guys think in the comments below. Think a first rate comes in the July meeting or not. Again, the weaker inflation data that we saw last week certainly makes it seem like a possible conclusion or a possible thesis. It felt very impossible, very unlikely until we got that reading. Now all of a sudden it starts to feel like a little more reasonable. By the way, Netflix is another one we'll look at after the close reporting. It was down pretty quick in the aftermarket after the equity market close. We'll check in and see where things played out in the after hours session. So bond prices a little bit down. The dollar index up about 0.5%. Looking at commodities, you can see the GLD and the SLV, gold and silver, both down. The GLD was down about 0.6%, silver about 1.7% lower. Copper prices, oil prices, everything but natural gas in the commodity space sort of in the red. Cryptocurrencies, that is, choppy. Bitcoin still holding its ground around 64,000. It did get down towards 63,000 earlier today, but did finish as we're recording this after the U.S. market closed, currently around 64,000. Ether prices up as well. Looking at the 11 S&P sectors, you can see what I had alluded to earlier. Only 2 of the S&P sectors were actually in the green and not by much. The energy sector, number 1, up 0.2%. Technology, essentially flat for the day. Utilities, number 3, down 0.1%. On the downside, you had healthcare stocks down over 2%, financials down over 1%, consumer discretionary down about 1% for the day. With the distribution that we saw, and I think this is on yesterday's close, the big down day for the Nasdaq, it was interesting. As you saw trading open today, sort of the logical thought is after you have a big distribution day, is today sort of an upside rebound day? It wasn't to happen, right? The Nasdaq finished lower yet again. And for now, the short-term market trend model for the Nasdaq, according to my work, has now flipped bearish, and it's been bullish here for a little while, coming off of the April low. I have to look at the tape to see when exactly it turned up. Actually, I can click on this chart. That's the beauty of the Stockcharts platform. Here it is. You can see that we turned bullish. We turned negative going into the April low. A couple weeks later, we turned back positive. We've been positive through this stretch. And as of today, it's come back negative. Now, I only formally update that model after the market close on Friday. So after tomorrow's close, we would formally update that to a short-term bearish signal. The S&P's market trend model for now remaining bullish, but just slightly so. If Friday's a down day, certainly could trigger that to be more negative. A lot of things struggling today, and if you look at what's called the Magnificent Seven and Friends, these are some mega cap growth stocks. You can see Meta and NVIDIA actually had decent updates, and this is after NVIDIA actually had a big distribution day yesterday, down a ton in one of the biggest names traded in the U.S., up about 2.5% today. I wrote an article for CNBC Pro talking about NVIDIA and some potential downside targets to keep in mind. So if you follow the markets over there, check that out. Meta Platforms, as I mentioned, up 3%. Tesla just slightly above zero. Amazon and Apple, though, getting dinged again here. And, as we get into the rest of the market recap, as I'm looking at something like Amazon, closing below the 50-day moving average is not a good look. Now, this comes after some bearish divergences that we've observed, coming after a overbought condition as we approach $200 a share. That became resistance for quite some time. Now we're trading like lower, and we're not really making a lower low just yet. And so I think charts like Amazon, really, you've got a clear support around 170 to 175. See if that's able to hold. The 200-day moving average a little bit lower on 166. See if that's able to hold. But overall, certainly in the last week, these feel quite distributive, I guess is the way that I would describe it. Let's continue on looking at the daily S&P chart. And as you can see here, not the end of the world yet. And sorry, I meant to have this cursor on here. As you look, we've had a couple down days for the S&P 500. We're still holding above trendline support. We're still holding the most recent swing low at 54.50. We're still holding the price gap from June and the 50-day moving average currently around 5,400. So overall, while this has felt painful for a day or two, we are still within the context, I would argue, of a long-term uptrend. That goes back to Charles Dow's work defining an uptrend as a pattern of higher highs and higher lows. As long as that pattern continues, we should not be too concerned about the long-term structure. The short-term structure, the tactical time frame, is where I think there's certainly some downside risk. I think if you're a swing trader playing the downside at this particular moment, feels like the right play, particularly going into some of the seasonally weakest parts of the year. July has been relatively strong. August and September actually fairly consistently weak. So the fact that we're getting a bit of a pullback going into some of the weaker periods of the 12 months kind of makes sense to me. But let's keep in mind that the long-term structure of higher highs and higher lows, of remaining above trend lines, support, and remaining above upward sloping moving averages, that's how I would still describe the S&P to this day. Now, things that have me concerned, number one would be a spike in the VIX. We talked about some potential risk signs, right? Signs that there is potential for the downside. A couple things we talked about were a spike in volatility, widening credit spreads, rise in the dollar. Not really seeing a spike in the dollar just yet, and credit spreads remain actually fairly narrow even through this week, but the VIX is certainly popping higher. This week, the VIX is popping above 15. It's the first time we're above 15 since the end of April, and the last time we spiked above 15 was here in early April. Make a note that move above 15 was not the end of the drop. It was actually the beginning stages of the drop. We went down another 2 weeks after that initial sign of the VIX getting above 15. So that's why I pay attention to that as an initial warning signal. Now, we have to get above longer term levels like 20 or even 28.7 or 28.5 to signal a much broader decline. This is not a major correction kind of signal. VIX above 15 just means we're probably in a pullback. And that's certainly what it feels like so far, just in the last 48 hours as an investor. It's felt very different. And that's what I would argue charts are really designed to do. And what I hope you're able to use the Stockcharts platform to do is recognize what we call changes of character. When the market has a certain look and feel, when it has a certain trajectory, when it has a certain trend phase, a certain momentum phase, and then something changes. I think the VIX popping above 15 could be one of those changes we might be looking for. A couple other things here just very quickly. Want to look at bullish percent indexes on the S&P 500. This is a breadth indicator driven by point and figure charts. It looks at 500 members of the S&P. Are they in a bullish or bearish signal with their most recent signal? The S&P 500's bullish percent index currently around 68%, not quite to 70. The last time we touched 70, and it just slightly didn't even quite get there, was in mid-May. We pulled back a couple weeks after that. The warning sign for me would be the bullish percent index going above 70. We're not there yet, and that doesn't mean we can't pull back. That doesn't mean there can't be some short-term pain. It just means we don't have that particular signal, which has been a very good predictor of market pullbacks going back over time. Worth noting, however, that this week the Nasdaq 100's bullish percent index has indeed gone below 50%. I think that's potentially a cause for concern, right? This indicator above 50% means most stocks are in a bullish point and figure phase. This below 50% It means the opposite. It means most stocks are actually in a bearish phase. It means a lot of sell signals have been generated in leading growth names, and there's a lot of market cap represented, and particularly the higher end of the Nasdaq 100. So that indicator getting below 50%, not an encouraging sign. You'd want to see that go higher as price action goes higher. We're seeing the opposite. To finish off our show here, let's talk about some other themes here. I just want to talk about what we call a leadership rotation. Here are your three growth sectors. Here's the technology sector, the communication services sector, and the consumer discretionary sector. And these data series are looking at relative performance. So a simple ratio of each sector ETF versus the S&P 500. These are cap-weighted ETFs that we're using here for simplicity, but overall it's intended to track the general trend in these different sectors as most often expressed in a portfolio where you probably own some of the bigger names anyways. As you can see, technology has been choppy to down here over the last couple weeks. Communication services has actually been flat to down here for a number of months. Consumer discretionary has actually been rotating higher and has actually outperformed over the last 4 weeks. But the real story, I would say, would be on the other charts here. Here are the four value sectors. And again, going into last week, not particularly strong on a relative basis. To be honest with you, consistent underperformers off of the April low. That is changing. The last week or two, we've now seen industrials, financials, materials, and energy all outperform. Looking at more pure defensive sectors like utilities, consumer staples, and real estate. Real estate in particular starting to rotate higher. What's interesting about those two sets of charts that I just showed you is those are high yielding plays, high income plays. These are stocks that are actually generating a decent income component. So if the price action is constructive and you get a healthy dividend, all of a sudden it's sort of a double benefit, right? A double whammy of good at a time when the market's most likely in a pullback phase because the growthy stuff, which are some of the biggest names in the index, are struggling. So sort of a high time to be outside of growth and into other areas of the market. Some of those things like money center banks have been doing well for quite some time. Industrials have been doing well in a lot of ways for quite some time. But a lot of the other stuff that is not doing particularly well is starting to improve. With that in mind, just a couple other individual charts and themes. I don't want to look at Scott's Miracle-Gro, but instead I want to look at semiconductors. You know, semiconductors is a potentially very concerning chart here. We're sort of right at that point, that sweet spot, where this is a perfect pullback to an ascending 50-day moving average. We'd still consider this a retest of the June swing low. The momentum is still okay with the RSI holding above 40, but we are very close to a scary sort of significant breakdown. What if we go a little bit further into next week where the SMH is clearly breaking its 50-day moving average, where we've gapped down below 270 and are not seeing any buyers coming in buying semiconductor stocks. We clearly break the June swing low. The RSI goes below 40 and the relative strength continues to go down. This is close. This chart is very close to being in a very much a pullback phase, indicating a deterioration. Again, there's a lot of market cap represented with NVIDIA and AMD and others in the semiconductor space. And so I would think concerning developments, and it's not just semiconductors, right? Things like Domino's Pizza, one of the worst performers, actually maybe the worst performer in the S&P today, down about 13.5%, gapping down today on earnings. And I would say the thing about Domino's Pizza, what I would tell you is that the warning signs have been pretty clear well before today. If you're still holding Domino's Pizza yesterday, you're still holding it at $4.75 a share, and you're shocked and surprised at this gap down, I would argue you've missed a lot of clear signs of distribution. Look at all the things that happened before today that could have told you that this chart was rotating lower. That's what I want you to think about. Bearish momentum divergence with the price making new highs on weaker momentum. The relative strength clearly deteriorating. Telling you that even if you're holding Domino's Pizza here, a lot of other things are doing a lot better. We've broken below an ascending 50-day moving average. We're below a downward sloping one. We've not made any more new highs. We're actually making a slightly lower high. Instead of holding price support on pullbacks, we're making a new swing low. So all of those things happened before today's gap down. So when someone asks me, oh, what do I do now with Domino's Pizza? My answer would be go back in time and pay attention to all the clear signs that this chart provided you. I think this is a perfect example of the benefits of technical analysis for risk management. Risk management, in my opinion, is about preventing significant capital loss. And that means recognizing when a chart that you hold is in a distribution phase. This is why I have a checklist identifying these markers of a rotation to the downside. I would encourage you to focus on some of the clear signs that we had of distribution before today's trading. WY I jotted down. I don't know why. Oh no, Eli Lilly. Sorry. Bad writing there. Eli Lilly is another one. This one I think is still maybe a bit of an open question. Now it's pulled back quite a bit. It's down about 6% today, which hurts, right? And it's down quite a bit from a peak around 970 less than a week ago. However, we're just closing below the 50-day moving average today. And you can see a series of breaks, slight breaks below the 50-day moving average. And it ended up being pretty decent buying opportunities. It's worth noting that the RSI sort of in that 30 to 40 range is kind of where that good opportunity has been. I think this is an interesting play right now to see if that 50-day is able to hold. And if so, this is where in a long-term uptrend, you may see buyers come in and buy in on short-term weakness. So if healthcare stocks are struggling today, if Domino's Pizza is tanking after rotating lower for quite some time, what is working? Things like home builders. Home builders, the ITB, up about 1.8%. By the way, if you're a candle aficionado, maybe a bit concerned to see that the ITB today has what's called a shooting star candle. That's where we open in an uptrend. We trade much higher, long upper shadow. We close back at the low. So long upper shadow, very minimal lower shadow, and the open and close are near the lows of the day. It's called a shooting star candle. It's a short-term bearish distribution candle, maybe suggesting we have a bit of a 1 to 3 day pullback. Worth noting that distribution candle pattern is happening as we retest the all-time highs from the end of the first quarter, end of March. But I would say stocks like DHI, some of the top performers in the S&P, DHI was up over 10% today, making a new 52-week high today. So keep an eye on that space. That's a play on lower rates, of course. As rates come down, homes are more accessible and less expensive for borrowing money for a mortgage. And so as a result, home builders are moving to the upside pretty well. Netflix, by the way, struggling in the aftermarket. We'll see what happens here today. As of today, going into today's earnings, testing the 50-day moving average, RSI okay, down about 0.7%. Let's go to the symbol summary page. You have a couple ways you can get there. I'll go right below the chart and click on simple summary. So it's interesting. Earlier, right after the market close, Netflix had actually gone down by about 4 to 6%. It was super noisy and was getting dinged in the aftermarket. It looks like by the end of their earnings call, and as investors were able to digest that information, actually pop back up. Did not finish too far from where we were today. I think Netflix is a key chart to see if it's able to hold that 50-day moving average. See if we get some buyers coming into the market on Friday session. Could represent an interesting opportunity in a growthy space that has been struggling quite a bit. Folks, that's a wrap for our final bar here. Thanks for bearing with us. We're doing the show a little bit later because we're on the road in Boston. Again, got to hang out with some of my former colleagues at Fidelity, which is a real pleasure. Great to see the chart room. Hopefully we'll be able to bring some content from the chart room at some point in the future. Fingers crossed. But for now, it was great to check in with those guys and revisit that cool space where I spent a number of years. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.